we founded it back in 2008. Before that, Nassim and I were together in a hedge fund called Empirical, where we did similar things. That started in the late 90s, and before that I was a prop trader and a pit trader in Chicago before that. And really, what's really unique about the way Universa goes about this, and this is really a necessary feature of mitigating big losses, and we can just call it tail hedging. Everybody knows what that means at this point. Although, interestingly, we really had to define these terms back in 2008 when Universa started. But we all know what tail hedging is. I try to stay a little bit away from that because I feel like that's really an overused term now. It's overused to the degree that I think it's lost really what's important about it. And really what's important about what makes tail hedging, and it really is what makes Universa unique, is the explosiveness of the payoff. If you don't have a sufficiently explosive payoff or sufficiently large loss in one's portfolio, the loss that you're mitigating, you can't call it tail hedge because you're no longer isolating sort of the tail of the distribution. You're no longer isolating just that big loss. If you have a payoff that's more in my safe haven book, I call it CTA-like, where you're trying to make 5 or 10% on your capital when the market's down a little bit or even a lot. That's not it's not convex enough or explosive enough. Getting maximal bang for the buck is what makes a tail hedge a tail hedge. It's what sets Universa apart, not only from literally all other risk mitigation strategies, but even among these things we now call tail hedge, the sort of tail hedge sort of asset class, it really is the thing that sets us apart. And it's every day, it's entirely what we focus on in our payoff. And my history is sort of relevant to that because really what I was taught as a kid, and I haven't written about this over the years, literally as a teenager, I was taught by an old corn trader at the Chicago Board of Trade that to be a good trader, you've got to know how to take very small losses a lot, and you got to know how to take very large winners. So you got to be willing to just lose, and then get a big winner. This wasn't necessarily as a risk mitigation strategy, sort of as a risk mitigation payoff, but that was just sort of as a prop trade standalone strategy as a pit trader. You need to be able to minimize your losses. So what does that mean? That means that you need to be positively skewed in your return payoff. So this really just got me focused on extremely positively skewed payoffs really from the very start, literally as a teenager. And so this is why I found my way to these very explosive payoffs, which happen to be really the only way to achieve cost-effective risk mitigation. And of course, this is something that's really, really hard to do. We like to talk about as traders or as investors, you want to, have this sort of positive asymmetry to your payoff, make more than you lose, certainly. But the reality is very few people are able to achieve that. Very few people even want to achieve that. I mean, you could look across the hedge fund space, you could look across all the strategies among whether it's hedge funds or prop trading desks, they're all quite negatively skewed, with very, very, if any exception. It's really, really hard for a professional investor or trader to focus on positively skewed payoffs because, of course, that means most of the time you're losing small amounts of money. You don't get that immediate validation of what you're doing. It's very hard to sort of even demonstrate alpha over the short run. When you're negatively skewed, of course, it's very easy to demonstrate alpha, even though it's not necessarily true alpha. It just look like you're making you would have alpha because when you're negatively skewed, you'll have a sort of positive median return, even though you may have perhaps a very negative mean return. That's the nature of negatively skewed versus positively skewed. So this is how I found my way inevitably to investing the way Universa does and performing risk mitigation the way Universa does.
And in 2008 is a really interesting time to start. Obviously, it was a coincidence that things were getting like and this is a real opportunistic time to start an investment strategy like this, given what was going on in the market.
Well, in hindsight, it feels like it'd be very easy for me to say that I saw it coming and we put the trade on, but it's probably more coincidence. This really is, and this sort of leads to an important feature of risk mitigation, the way Universal specifically does it, and that is it should be thought of as strategic rather than tactical. Not only don't I believe that any of us really have any edge in timing these sort of macro or systematic swings in the market, but from a risk mitigation strategy standpoint, you shouldn't even assume that you do. It sort of contradicts the whole point of risk mitigation, which sort of says in and of itself that you don't have such an edge. Why would you need risk mitigation if you did? So let's just call it a coincidence that we started in. We didn't need it to be that way. It's part of this idea of strategic means that you don't need timing, but not only that, we don't even need there to be a crash. It's a very counterintuitive thing. We'll get to that maybe a little bit later, but it's very counterintuitive to think that an explosive tail hedge payoff like Universa has, you don't need a crash for it to show its cost effectiveness, to show how good it is. But that's really one of the things that's so special about it, is that it actually allows you to take on more systematic exposure, not less. So that's a really big difference in risk mitigation approaches. Your more standard sort of diversification approach, I like to call it diversification, I would steal the term diversification approach, is more of a dilution risk. It's more of taking less risk, sort of watering down your portfolio, if you will, which of course with that comes lower returns by definition. But when you go about it by targeted risk mitigation, by targeting the big losses in this explosive payoff type of way, it actually lets you take on more exposure. I like to use the analogy of race car driving. As you go around go around the track, one way of mitigating the risk of flying off the track would be to just drive slower, and that's really what diversification is. But another way to do it is to pull off in the pit. It's costing you some time, so it looks like in the short run, perhaps it's costly. Change your tires, which then allow you to drive faster. So this is a really important distinction between the two. But really, what it leads to is this a much bigger difference sort of viewpoint in what risk mitigation means. In modern finance, that risk mitigation, even investing itself, is really about lowering the volatility of your portfolio such that you optimize how much you're lowering that volatility relative to portfolio. It's okay if you're lowering your expected return of your portfolio as long as you're lowering your volatility more. So that ratio is going up. Sort of begs the question, what is the point of action? Risk mitigation, when done well, raise your rate of compounding. Should that be, if you're getting losses effectively?
Hi everyone, James here again. What I'm going to do is I'm going to call it there due to the quality of the sound and the visuals, just not something that we should all be sitting through on a Monday morning. I'm told there's some network issues around the country, so I can blame it on that rather than the skills of my operating a technological drama on a Monday morning. But what we'll do is it will be up on the podcast so you can listen to it, and we'll also try and send out that video so you can watch it, because sometimes the interaction is good, and also there's a few screens that Mark shares around some of the returns that would be worth looking at. So what we'll do is we'll try and get that together as quick as we can and send it around to all participants so you can watch it in your own time. Really do apologize for that this morning. But I guess the final thing to take out of what Mark was saying is there is two types of mitigation that NZ Funds participates in. One of them is downside mitigation for black swan events. And the importance of this is you just don't know when a black swan event is going to happen. And things could be running along smoothly, And it could be anything from a geopolitical event to something happens in the market that was unforeseen to a slow but steady market degradation, whether that's raising interest rates and all of a sudden the market capitulates. So many things can cause one of these black swan events, and this is why we have Universa. They're sitting there waiting for one of these events to happen, and they're not trying to do anything else. And so that might not be with our wealth for many years, but a black swan event does come along, and as we said in the start, it does happen about every 7 to 10 years. COVID was a great example of that. We almost had a black swan event, which is greater than 20% market downturn at the end of 2018. And obviously we had one in the GFC back in 2008, 2009. The other downside mitigation is when we see market volatility and a market degrading over time, perhaps longer than just 1 month. And this is really what we're facing at the moment. And this is why we need to also have downside mitigation where we are actively managing the portfolios. So what we're doing now within the portfolios is we have put options to protect the portfolios given what's going on with volatility. We've also taken risk off among some of the more at-risk part of the markets. For example, technology, which is more susceptible to a drawdown given raising interest rates, and also specific shares and bonds that are perhaps a bit more exposed to what's going on in Europe. This is a bit harder to manage because of the market volatility. And so what we're trying to do is just reduce our exposure, take risk off the table, but at the same time, if markets were to bounce back sharply, we would still participate in the upside. But that is very different from what Universa do, which is what they're trying to do is manage a black swan event. And what the Universa allows you to do is stay relatively fully invested throughout a market cycle, knowing you've got that protection if something untoward was to happen. So two quite different strategies, but both those strategies are at the real forefront of what NZ Funds is trying to achieve in terms of downside mitigation from a share market downturn. And so we'll explore more of Universa when we send out that video, but we'll also explore some of the things that NZ Funds does in the interim when it's not quite a 20% drawdown, which can really help with client portfolios staying a bit more stable. And what we have seen is we've seen that part of the strategy, the NZ Funds active management part, really come into its own in the last couple of months where markets have been down quite heavily and client portfolios have been positive. So we'll end it there. Apologies for that technology mishaps, but we'll send that video around and look forward to speaking again, same time, same place next week. Thanks very much and have a fantastic week.